Welcome to Macro Musings, where each week we pull back the curtain and take a closer look at the most important macroeconomic issues of the past, present, and future. I am your host, David Beckworth, a senior research fellow at the Mercatus Center at George Mason University, and I'm glad you decided to join us. Our guest today is Samim Ghamami. Samim is a returning guest. He joins us today to discuss the long-term implications of the US Treasury market for the future path of interest rates, inflation, and the ongoing reforms in this market. Samim also joins us to share his thoughts on the growth of private credit. Samim, welcome back to the program.
Hi, David. Thank you for having me again. It's good to be here.
It's great to have you back. Now, we keep running into each other at conferences.
That's right.
You were at the Hoover Monetary Policy Conference. There was an SOMC conference here in town.
Yeah.
So you stay engaged in this community, this policy space. I know you're at other conferences as well. But I wanted to bring you back on because you've done a lot of work on the Treasury market. Mm-hmm. There's a lot happening there, as you know. In early April, we saw some turbulence in the Treasury market. It's the one thing that caused President Trump to actually kind of pull back from some of the extreme tariff measures. We'll see what happens going forward. There's lots of reforms in the Treasury market. You've worked on them, central clearing. We'll get to those later in the program. I want to talk about that. Where does that stand? I mean, at the SEC, that was the work you were doing. You were working on the new SEC rule and then other things going on there. Recently, the supplemental leverage ratio was also suggested tweaks to that. So I'm going to come back to all those interesting developments there. But let's first jump to the fundamental, I think, core problem, and that is just the path of debt in this country, our fiscal trajectory. We just recently had the one big, beautiful bill, right, passed. And depending on who you ask, it's going to add a lot of debt to our fiscal path, our trajectory. So just some numbers here. Currently, we're around 100% debt to GDP. The CBO has us getting to 120% debt to GDP. So that's going from 28 trillion of marketable publicly held debt to about 50 trillion. If you ask some others, like the Committee for Responsible Federal Budget, they get us past 120. If some of these things are made permanent, it's even larger. In fact, I just saw recently the CBO was asked to reevaluate the cost of the One Big Beautiful Bill if some of the provisions are made permanent. And it went from adding, I believe, 4 trillion to 5 trillion, over the decade, just extra and above and beyond the existing deficit. So just a lot of debt being added. Again, just to make this concrete, the deficits are going to be like $2 trillion a year, every year. We're not in a recession. We're not in a pandemic. We're not in a war. That's just crazy, right? And then interest payments are about around $1 trillion. And then CBO projects by the end of the decade, they'll close to $2 trillion in interest payments alone. This doesn't sound like a healthy environment, does it?
Not at all. Not at all. Yeah, it's scary. And exactly like you mentioned, I think the trajectory is not sustainable at all.
Yeah. So somebody's going to have to deal with this at some point. I mean, maybe President Trump's like, I'm going to get my goods passed, and maybe someone else will deal with it later. But this is important for the question I want to get to here, and that is the path of interest rates. So for a long time, we've talked about interest rates during the 2010s that were really low, close to the zero lower bound in many cases. Now they're higher. Mm-hmm. Are we on a permanently higher trajectory for interest rates in the U.S. and maybe globally too? I guess we could tie these together. And why?
Yes, I think indeed that's the case. I think part of that, at least in the U.S., is because of the trajectory of public debt and deficit, exactly like you just mentioned. I think there are well-founded empirical studies showing that, for example, an additional 1 percentage point deficit to GDP would raise long-term real rates by something around 40 basis points. An additional 1 percentage point in debt to GDP would raise long-term real rates by around 3.5 to 4 basis points. So the fiscal situation is definitely something that would push long-term real rates in the U.S. higher. So that would be a reversal from the era that you mentioned, right before the global financial crisis and the decade after the global financial crisis before COVID. So the fiscal force fiscal situation is a big important factor. I think another one is the ex-ante investment and saving behavior of the private sector, both households and non-financial corporates in the US. I mean, in the household sector, it is now well known that there are forces because of the dramatic changes in demographics that would lead to households having lower and lower saving rates. So we know that, for example, the dependency ratio in the US is going higher and higher, meaning we have more dependents compared to workers, and more dependence, essentially means more consumers compared to producers. So that by itself is inflationary. And that's not just a factor that is playing out in the US. I think in all advanced economies, also even in China, compared to the rise of China in the 1990s and right after the GFC. So the household sector, the impact of demographics on the household sector. So saving ratios would go down and would go down faster than investment ratios. So this would create a force that would push real long-term rates higher. Discussing this, the ex-ante saving and investment behavior of the non-financial corporate sector in the US is trickier. But I'll pause here, see if you would like to discuss the household sector more before I turn to that.
So two things you've mentioned. The fiscal trajectory is pushing up interest rates or treasury yields, as they say in the parlance. And then also household saving spending patterns are also a factor. And both of those are going to lead to higher rates. So if you did not get a low mortgage rate in 2021, 22, that's never coming back. So sorry, listeners, for those who I have friends back home, Samim, who say, David, you have one job in DC, and that's to lower interest rates. And I'm like, look, I have no ability whatsoever, because they saw what happened in 2021. But let me go back to this household question and this age issue. The aging of the planet, right? So prior to 2020, there were a lot of people saying that the aging of the planet would actually lead to lower interest rates. People live longer, they save more as life expectancy goes on. Now, there were people who pushed back against this, and you're telling the other story is they have to start spending some of those savings. Is that
exactly
okay? And the dependency ratio is high, so they're not producing new wealth and savings. They're spending what they have.
Exactly. I think because it would be hard to increase the participation age. It's hard to increase the retirement age, at least in the US, going from, let's say, 65 to 70. And when the life expectancy goes up, if I die at 85 and if I retire at 65, then naturally I would consume more as opposed to saving more. So another way of saying this is, yes, as we live longer, we save more, but it's like a one-time effect. And once we get to that point, we're going to start spending it down. Exactly.
Okay, and we've reached that point, is what you're saying.
Exactly. Okay. And there are other things. So, for example, high healthcare costs associated with getting just older and older.
So then this circles back to another problem we've discussed on other episodes on the show, and that's our declining population growth rate, declining fertility rates. All those things hugely bear on the fiscal position, on interest rates, and all those other concerns.
Exactly.
All right.
Exactly.
So we want to have a robust immigration policy,
hopefully
get more people coming to this country and have more babies. But that's for a different conversation, different time.
True.
All right. So you're saying, though, interest rates are going to stay up. So give me a ballpark range. Where do you think rates, like 10-year Treasury, where do you think real rates will be going forward?
Sure. Before that, if you don't mind, I would just mention the behavior of the potential change in the behavior of non-financial corporate
let's
sector
go there.
when
Yes.
it comes to
Yes.
ex-ante. So I think that part is a bit tricky because we know that from 1990 till 2020, I mean, overall, particularly after the global financial crisis, we had really high corporate profits in the US, again, non-financial corporate profits. But the investment ratios were low compared to saving ratios. And one could think of different reasons, for example, high concentration and monopolization in the corporate sector. Another reason could be potential misalignment of management incentives. So essentially corporate governance and corporate finance reasons. Another is cheap labor. So it is related to the demographic factor that we just discussed. If cheap labor is abundant, this means that in the corporate sector, it would be more profitable to hire cheap labor as opposed to increase fixed capital investment.
Okay.
But if the main cause has been, let's say, cheap labor because of the reversal of the demographics, so that may incentivize the corporate sector to invest more as opposed to save more. So if that materializes, then that would be another push to increase long-term real rates. But again, I mean, this analysis in the household sector is a bit more straightforward compared to the corporate sector.
Okay.
Because if you believe that monopolization, concentration would go on, if you believe that managerial incentives are misaligned, i.e. some corporates that focus on maximizing return on equity would not have enough incentives to make long-term capital investments, then it would be tricky to conclude that investment rates would go up, saving rates would go down. But again, if the main cause has been cheap labor, then I think we would see a similar trend that we just discussed in the household sector, similar trend in the corporate sector. That would be a force that would push real rates high. Now, going back to your question, I think it's just a very crude guess, but I think we won't be back anytime soon in the era that long-term real rates would be anything below 1 or 1.5%. Let's say if inflation would get closer to the target, so this means that on average, let's say for a 10-year treasury yield to 30-year treasury yield, we won't see yields being below, let's say, 3.5%. So if we see that, that might be inflationary.
Okay, so what you're saying is all the stars are aligning for higher interest rates, no matter how you slice or dice it.
I think so, except for that huge uncertainty in the investment for the non-financial corporate sector.
Okay, so higher interest rates, which just circling back to why this matters for policy, means we're going to have higher financing costs on the national debt, right? We're going to see these $1 trillion plus interest payments going forward. I believe this year is the first year where we've seen higher federal expenditures going towards payment on interest on debt compared to national defense.
Exactly.
And that's usually not a good sign for the health of a country.
Exactly.
Okay, so we worry about that. We also worry about tough choices we're going to have to make going forward. No one wants to touch entitlement reform. But if we start running out of options, there's very little left in the bucket of discretionary non-defense spending. We nibble at that thing, try to, make cuts, but that's getting really small. What's left is entitlements, defense, and those are really the two, and then interest on debt, which we have to meet our obligations there. So the choices are getting very narrow and few going forward. So tough choices have to be made going forward. Or the alternative, and this is maybe a nice segue into the next point, the alternative is we finance all of this with inflation, higher trend inflation. That's one way to pay for this. And I suspect that might be what we have to endure. But before we get into inflation, any final thoughts on interest rates? Like the global picture, are you seeing something similar happening globally?
So I think it would be more difficult to say at the global level right now because of the whole uncertainty with regard to trade policy.
Okay.
It would impact exchange rates. So, for example, in well-known studies of the determinant of forces behind long-term real rates, we know that, for example, all advanced economies would be considered as one block. So the reason was, net capital flows, net current accounts among countries in the advanced economy block were not variable, and the absolute net values were small. So that would make that type of study for the real rates in advanced economies well-founded and meaningful. But now, because of the trade war, so for example, we know that the US dollar depreciated heavily, around 8 to 9% from early 2025 till last month. The same thing happened with Chinese yuan, with renminbi. So that type of huge exchange rate movements and volatility would make it very difficult to study and analyze long-term real rates at a global level.
One observation, if we view the trade war as a negative supply-side shock, wouldn't that lower at least temporarily lower the equilibrium rate a little bit, maybe put some downward pressure on interest rates? We're less productive, less return on capital.
So I personally think it would be difficult to say, because of the, increase, even one-time increase in inflation. So it would also be difficult to say because, for example, some good economists predicted that when the trade war begins, the US dollar would appreciate. The exact reverse of that happened, at least for the first 6 months of 2025. So I think it would be very difficult to say.
Difficult to say, but at least in theory, and ceteris paribus, all else held equal, if you make the global economy less productive, you lower the return on capital.
That's right.
But but the point is, there's many moving parts.
Exactly.
And so anything, we don't know what's going to fall out at the end. Okay. But it'll be interesting to see where global rates go because there is this convergence through arbitrage and markets that would pull rates together, even if some, emerging markets will be different than advanced economies, but there's still some kind of, some common trend there, right?
Exactly. It used to be the case, like we just discussed before 2025, at least in all advanced economies, long-term real rates move very closely to each other, even during crisis episodes.
Yeah. And just stepping back, the 10-year Treasury yield, if we look at it right now, it's 4.3 something.
Yep.
It's still not terribly high. By historical perspectives.
By historical perspective, exactly.
It's exactly high compared to the 2010s
exactly.
and 2000s before 2020. It's still it's high there, but it's low if you go to the 90s, 80s. So in the grand scheme of things, we're still not that high. So even I joked earlier, if you didn't get a mortgage in 2021, you can still get a mortgage 6-7%, which is low compared to say the 1980s or 1990s, right?
Exactly. It's not high compared to the history of interest rates in the U.S.
Okay. All right. So, but the concern is it could get worse. I guess that's maybe where you're.
That's right.
Especially the fiscal trajectory. If we crowd out private investment, so there are concerns going forward. So far, it hasn't been as bad. And I am actually quite surprised yields on treasuries haven't gone up more. Are you?
So why are you surprised? So, for example, at the very beginning, an episode that we're going to discuss is the short April turmoil in the US Treasury market.
Yep.
But we could have episodes that Treasury yields would go up. But if we believe that the long-term real rate, the so-called R star, is something between 1.5%, if we believe that we are close to the 2% inflation target, a little bit above that, so that would make the 4.5%
seem reasonable.
Yeah, exactly.
Okay, so here's why I'm surprised. And maybe I'm surprised, to be clear, about nominal interest rates being higher. Maybe real rates will be where you said, they are 1 to 1.5. Mm-hmm. I'm surprised because I look at the fiscal trajectory, and it seems to me there's no way we're going to pay for that with taxes. We're going to be paying that with, I'm guessing, inflation. So why hasn't
unexpected inflation?
So why hasn't the market priced that in? I mean, the bond market is far smarter than me. There are people who have skin in the game who are trading. They're, they look at far more information than I do. But in my mind, it seems pretty clear. The easiest path forward is to have higher trend inflation. So why hasn't the bond market seen that? Or am I just being naive or misguided or what?
No, I think it's part of that because of the strong commitment of the Fed to using its interest rate tools to target inflation. So
inflation fighting credibility is still strong.
So we can discuss that further, but still, I mean,
for now,
exactly. So
okay,
because of the relatively strong commitment to inflation targeting, to the so-called Taylor principle.
Okay, so I'm going to go on a limb here and say that we have not awakened up yet to the regime change that is coming. There's going to be something that triggers, and one day
I agree with you.
We're all going to be like, "Oh my goodness, this is going to be higher trend inflation, and we need to do something about this."
I agree.
Okay, so maybe that's it. So you listen to Fed officials. They're still in a very much a monetary dominance regime mindset, right? We set the trend inflation rate. We set overnight rates, as opposed to fiscal dominance regime. They're subordinate to what Treasury and Congress needs. And I guess I think we're getting close to that. Mm-hmm. And maybe the realization hasn't dawned on them, on the markets. But again, in saying that, Samim, I'm being pretty bold because I'm saying I know more than they do, which I'm very leery to do that because I have made some pretty bad calls in the past. Okay. So listeners, don't take me too seriously. But let's move into inflation.
Yeah, sure.
Okay, we've talked about interest rates, and this is a nice segue because it is, I think, useful to talk about Treasury markets, debt, and inflation. So I want to read to you an exchange that took place in 2021 between a prominent MMTer, and we would classify this group as post-Keynesian, the very functional finance. There's some truth in there. They take balance sheet sectoral approaches seriously, which I appreciate, but they also push it a little too hard, in my view. Mm-hmm. But Stephanie Kelton is having an exchange with Jason Furman. Mm-hmm. His real famous exchange was then Twitter, now X, and they're going back and forth, and this is April 2021, and she says, "Have you considered the possibility that raising rates might move inflation higher? ? And Jason Furman emphatically says, no. And that image I have here in front of me as we're talking was shared widely. She was kind of mocked. She was like, "Oh, how crazy is this idea? We know when rates go up, it slows aggregate demand down, right? It slows spending, it slows inflation." But it's actually more complicated than that, right? I mean,
exactly.
So she was onto something, but it depends on the regime we're in, and sometimes the Taylor principle is not enough, right? I mean,
exactly.
Okay, so let's talk about that, and that's, again, this is all weaved together, right? We are now having interest payments on debts at $1 trillion. They're projected to grow every year over the next decade. By 2034, about a decade from now, they're going to be close to $2 trillion. So where's all that money going, and how is it being financed? So walk us through why this is more complex.
I think, politics aside, it is very well known among economists, particularly macroeconomists, that a hard precondition for an inflation targeting central bank to achieve price stability is that government would have a balanced approach to its budget. If that condition is not met, then there are different settings that theoretically you can show that higher interest rates could lead to inflation spiral. And there is also empirical evidence on that. So, for example, in a relatively well-known paper titled Tight Money Paradox, Eduardo Loyo, an economist, Brazilian economist, assigned exactly this phenomenon to what happened to Brazil between 1975 to 1985. So at that time, Brazil was experiencing high inflation rates, but from 1975 to 1980, they didn't have strongly anti-inflationary central bank, meaning responding more than 1-for-1 to inflation.
Yeah.
But that approach switched from 1980 to 1985, and the moment that the central bank in Brazil became aggressively anti-inflationary, they experienced hyperinflation between 1980 to 1985. And so, for example, I had the opportunity to discuss one of Mike Woodford's paper last December, his 2001 paper titled Fiscal Requirements for Price Stability. So this essentially, the essence of the paper is that if the public debt and deficit, the trajectory of that is not sustainable, the central bank, which is inflation targeting using Taylor type principle, could become dysfunctional. So that's a hard precondition. I mean, the government having a balanced budget approach is a well-known strong precondition for a central bank to be able to function well. And we can, discuss the details of the model, but that's a very well-known result.
So that's so interesting. So in Brazil, from 1980 to 1985, they actually followed the Taylor principle, which says raise interest rates more.
Yeah.
Right? Raise it more so that you kind of get ahead of, in front of inflation. And that's like this beloved, John Taylor came up with it. It's in the Taylor rule. It's in most macroeconomic models, the Taylor principle, but it's regime dependent. It doesn't always work if you're in a regime where it's a fiscal dominant regime where the debt stock is so large.
Yeah.
And that's the thing. We assume a monetary dominance world in our minds. Most living in the US and Europe, it's been the case that we've been in a monetary dominant regime where, at least implicitly, we're fiscally solvent. Taxes, spending's being managed in the background. But this should be fairly intuitive, right? If the amount of debt gets so big, how do you pay for it? How do you pay just the interest? How do you roll it over?
Yeah.
Well, if you follow the Taylor principle, inflation's going up, you got to raise, that's going to be very costly. How does the central bank finance? It's going to have to start borrowing money itself, right? It's going to be effectively printing money to pay on that. So it just feeds into it. So here's my point. Going back to Stephanie Kelton's comment, though, in 2021, I think Jason Furman's answer was an emphatic no, made sense at that time, right? Because at the time, it was at least perceived, and I think fairly so, that the debt stock wasn't, as big or unsustainable. You could debate that, but the point is, it was the markets at least believe that we're not in this place yet, right?
Yeah, exactly.
But it looks like we're getting closer. That's the point. We're getting closer in the U.S. to this place where we trip into or fall into.
Closer in the sense that the trajectory is not sustainable. But for example, if you ask me whether that would materialize 10 years from now when the deficit to GDP is 6%, now it could be 10%, I think it would be very hard to put estimates on it. But I think everyone knows that. I think maybe it would be a good time that we are flagging this strong precondition of a government having a balanced budget approach so that the central bank can be independent, can achieve price stability. So I think this is a good time to discuss it.
Yeah. And to be clear, you can still run deficits during recessions. The key is during the good years, you run primary surpluses. You pay off the debt, or you pay down what you incurred in the bad year. So you balance it over the business cycle, or are you saying this flat out, no matter what, you have a balanced budget?
So this happens when, strictly speaking, when fiscal policy is not Ricardian, in the sense that when this constraint that the real value of nominal debt more or less should be equal to the present value of expected future surpluses.
Yeah. So
if
tax
that,
receipts coming
exactly.
in. Yeah.
So if that equality gets violated, we say that we are in a non-Ricardian regime. And when we are in a non-Ricardian regime, there might be situations where aggressively anti-inflationary central bank could make the inflation situation worse. And again, this has been shown theoretically in good papers 20, 25 years ago, and also empirically.
Yeah, in fact, there was a new paper that just came out. I'll mention that Lucas Rachel and Morton Ravin, Brothers in Arms, Monetary Fiscal Interactions Without Ricardian Equivalents. And they make the same point. If you don't have Ricardian equivalents, in other words, plain English, for those who don't know the macro language, what we're saying is the government it runs a deficit this year, and it's not committed in the future to paying that off. It's not gonna have taxes in the future, revenues coming in to offset it. So it's not being paid for over some long horizon. In that case, it's going to be potentially inflationary given the circumstances.
Exactly.
Yeah.
Exactly.
And particularly in the context of, in the real world, we see this when there's a huge amount of debt and people don't believe that there's literally a belief that the government's just going to finance through printing, through creating liabilities of the central bank, and that's just going to shoot prices through the roof. Now, let's go to an example. So in Argentina, President Milei, he's actually bringing inflation down. It's still positive, but it's come down a lot. And I believe he turned the fiscal picture around quite dramatically. So he'd be an example where he's taken this idea seriously, right?
Exactly. And that happened also in the Paul Volcker era. So during the fight for inflation in the US, at some point, the US government adopted a essentially balanced budget approach, essentially conventional deficit targeting. So you can contrast it with what happened around the same time in Brazil, as we just discussed.
So you're saying then it wasn't all Paul Volcker that brought the inflation?
Maybe it was him convincing the government that, to fight inflation. So the ideal situation is the central bank following the Taylor principle and the government having a balanced budget approach by, for example, conventional deficit targeting.
Yeah.
That's the ideal situation. And that ideal situation, I think Paul Volcker was able to achieve it in his era.
And again, just to be clear, it doesn't mean you have to run a primary surplus that year, but it's the expectation in the future So even if there were deficits during Paul Volcker's years, the question was it a primary deficit or just a deficit? Because it could be a deficit due to interest cost. But more importantly, was there an expectation that the government was changing directions on its fiscal path? Right?
Exactly.
So it's a lot of this is expectation management, right?
Yeah, exactly.
Credibility, expectation management.
Exactly. People beliefs about government's fiscal policy. So I think it would be maybe one way to say it is that inflation expectations that are extremely important are themselves at times functions of people's fiscal expectations. So if fiscal expectations go in the wrong direction, that could adversely impact inflation expectations, and that could lead to inflation spiral. Yeah.
Make it much harder to get things back in order. So that's the key is we still have relatively stable inflation expectations.
Yes.
Which, again, is a little surprising to me. And my worry is there's going to be some regime change where we wake up one day and we're like, oh, my goodness, we're headed off a cliff and there goes inflation.
Right. And I think another factor maybe to mention here is that because we discussed Brazil and US around the same time, 70s and 80s, at that time in Brazil, most of the government debt was in short maturity contracts, the equivalent of treasury bills. Right now, I think treasury bills are less than 30% of the marketable government debt in the US. So the basic idea is if you have most of the government debt in short-term maturities, what we just discussed would be exacerbated in the sense that that inflation spiral, because of the unsustainable path of public debt and deficit, may materialize faster.
Okay, so if I'm Treasury Secretary Bessent, I should try to finance everything long term. I mean, I know the system needs T-bills, but finance long term if you think there's going to be high inflation in the future or unsustainability, 'cause it would help, right?
So right now is below 30%. I think if that goes highly above 30%, that could be potentially more inflationary.
It'd be a sign. It might be a sign too, right? That's the other thing. Ideally, you lock in those nice long-term rates, even though they're higher now, 4.5%. It may be even higher in the future.
But that would delay the rise in inflation.
It wouldn't avoid it. Just delay it. Okay. At the end of the day, you got to get your fiscal house in order.
Exactly.
So one last thing on this. I want to just, again, tie this into the present, and I've mentioned this on previous episodes, so I apologize to the listeners who have to keep hearing this from me. But I really think we're getting close to this point because we see what I think are symptoms or signs that we're in trouble. President Trump's pressure on the Fed to cut rates has been largely for fiscal reasons. Like we will say if he goes in from $800 billion to $1 trillion, if only Powell would cut rates, And what he says has very little to do with the state of the economy. Now, maybe we just got a really bad jobs report. He'll change his tune. It's about the economy too. But President Trump's calls for Jerome Powell to cut rates has been about reducing fiscal pressure. We're going to talk more about this in a minute, but supplemental leverage ratio. Why are we even talking about that? I think one reason is because it would reduce fiscal pressure and make it easier for banks to bear more Treasury debt, right? If we had a much lower debt to GDP ratio, it may not be as consequential. Senator Ted Cruz talked about ending interest on reserves. Why? Because it would save the government $1 trillion. I'm not sure that's correct, but point is, all this talk, this noise about ways to save money here or there, has me worried. Now, I bring that up. I also want to mention that many people who are Fed watchers, like ourselves, are getting worried about Fed independence because Trump has been so aggressive. He's gone after them for many reasons. Rate cuts, the cost of the Fed building overrun. They're just not doing their job. He's threatened to fire Powell with cause. And, the political independence of the Fed. The legal independence of the Fed. Or, And I think what you're getting at is actually something more fundamental than norms. So those are all norms. Fundamentally, it's the economic independence. Exactly. Can the Fed actually use the Taylor principle and it work? And that's only true if we have our fiscal house in order.
Exactly.
Yeah. So I'll put a plug in for a Substack newsletter I wrote. For those who are not subscribing, please do so. But the title of it rips off of Ben Shapiro says, the facts don't care about your feelings. Mm-hmm. So I kind of played with that and I said, the consolidated government budget constraint doesn't care about your Fed independent feelings. Mm-hmm. There is no Fed independence if we are in a fiscal mess because the government consolidated budget constraint is going to say, well, the Fed's going to be forced to help out. So.
That's right.
Okay.
That's
so
right.
Realistically then, we let's say we go into fiscal dominance. I mean, how do we get out of it? What is your realistic assessment? Is it going to be higher inflation to pay off some of that debt? Is it going to be tax spending changes? How do you see as a realistic path?
I mean, honestly, I can't think of any way other than fiscal consolidation, other than having target for conventional deficit. So I think that would be the ideal scenario. I think you mentioned along the way one big beautiful bill. I think it's good that it is pro-growth, but we know that long term it would add, I don't know, depending on who you ask, 3.5 to 4 trillion, 10 years to 30 years to the debt. It would not change deficit if we have more than 300 billion revenues from tariffs by the end of this year and next year. So this wouldn't do anything about the trajectory of the public debt and deficit. So honestly, I don't see any solution other than, again, the government having a balanced budget approach. So that would mean finding ways to cut spending, finding ways to increase taxes. So
one other point I want to bring up, Samim, is a recent article by Olivier Jean. He's, I believe, at Johns Hopkins, and he has a paper, really interesting MBER working paper, where he talks about the stages of financial repression, I would say fiscal dominance, and he looks at a bunch of cross-country data, and so it may not always apply in every case, but in general, he notes between 100% to 120% is when you begin to see the cracks in the system, where you begin to see calls for the central bank to do more, to start lowering rates. And not only the central bank, but banks. He mentions banks, in the case of the U.S., maybe money market funds, to start holding more securities, which, again, I look at a supplemental leverage ratio, right? That could be seen as a symptom of these greater pressures. So let's go into Treasury market reform in the time we have left here.
Sure.
Tell us about where it stands, and maybe we can go through that, and at the very end, we can circle back to how this relates to what we've been talking about. But let's start with central clearing. Where are we with that?
Like we discussed last year, in roughly 2 years from now, most of the secondary part of the Treasury market, Treasury cash, repos, and reverse repos would be cleared through central counterparties, definitely FIC, which is a subsidiary of DTCC, and maybe CME as well. And I think that's a positive. So we just discussed that the fundamental problem is supply and demand imbalances in the Treasury market. Yeah. But the Treasury reform has been mainly targeting what we can do to make sure that the US Treasury market remains liquid. So central clearing would help that, and it gets implemented in 2 years from now. So you mentioned supplementary leverage ratio. So we know that, for example, because of the disruption in the Treasury market, March 2020, large banks that are major market makers in the Treasury market could not absorb a sufficient amount of Treasury securities because of balance sheet constraints. So the reform of the SLR, or to be more specific, enhanced supplementary leverage ratio, the version that applies to U.S. global systemically important banks, that would hopefully help increase the intermediation capacity of large banks. So another element of the reform was trying to align the capital and liquidity requirements and rules for non-bank affiliated broker-dealers that are essentially liquidity providers active in the Treasury market. So the reform of capital requirements for non-bank broker-dealers is another one.
What about like Treasury buyback program? Is that more of a liquidity tool? That's something new the Treasury's introduced.
Exactly. So I think that would also help, but in normal times. So the Treasury introduced a buyback program on a regular and predictable basis, I think 1.5 years ago, and it would help maintain the liquidity in the US Treasury market in normal times. Another thing that we discussed last year was the standing repo facility.
Oh, yes.
I think that's very important. It continues to be open only to the trading counterparties of the New York Fed. We discussed that if there would be ways to open it to more than just trading counterparties of the New York Fed, it would help maintain the liquidity in the U.S. Treasury market. Central clearing could facilitate that. I think two factors that we did not discuss last year were the Genius Act. So if the market in stablecoin would scale up, and we know that, for example, in Tether, more than 70 or 80% of the stable coins are backed by short-term treasury bills, essentially. So that could itself increase demand for treasuries. We can discuss potential financial stability concerns associated with scaling up in the stablecoin market, in general in digital asset market, but that's something that could be increased demand for treasuries. And lastly, tokenization of treasury securities. That could also lead to some increase in demand for treasuries that in the long run could help the liquidity in treasury market. But again, there are many caveats here because during stress episodes, we need to be very careful about financial stability risk as well.
We talked about this last time, but part of the problem with the treasury market is that it's changed so much, and the broker-dealers are a smaller part of the market. You rely much more on these high-frequency traders, and they're in and out of the market. Things go bad, they get out. They have no incentive to stay.
That's right.
And so you got to have these facilities, these tools, these innovations in place to keep the market robust. And like going back to the standing repo facility, I love what you suggested, bring central clearing. I know Gerald Duffy has suggested this.
Yes,
so the Fed would only face with FIC or some central clearing body, and they in turn would face these other counterparties, which, look, I'm all for that. If anyone's listening, let's go. I mean, I would love to see us in the long term move to a ceiling operating system, demand-driven ceiling system, which is what many other central banks are moving to. It's a long journey, another long conversation, but this would be part of the way of getting there is making the standing repo facility more functional. Also, the discount window more functional. And there's a lot of issues to work through. But again, stepping back in the minutes we have left here and circling back to the discussion we've been having, are we not talking about all these reforms to the Treasury market because the Treasury market is getting so big and the expectation is going to get bigger with the fiscal trajectory? In other words, hypothetically, if our debt to GDP was 50%, not 100% going on 120, we probably wouldn't be as concerned in talking about all these innovations. Is that fair?
Exactly. The main problem, supply-demand imbalances, the main problem, the unsustainable trajectory of public debt and deficit in the U.S. One could say, I mean, because of the cutback in globalization, for example, we know that in around 2009, treasury holding of foreigners, private sector, official sector was around 53%. Now it's around 35%. So all these forces, I think, are not in our favor.
Yeah. So it's important that we're doing these reforms. They're needed. I mean, we got to do something, right? Can't stand by and let markets blow up like they did in 2020. But fundamentally, it's not going to be the fix, right? Fundamentally, there's still going to be stresses on the Treasury market no matter what we do. Mm-hmm. And so we need to really get at the demand-supply imbalance, as you said, or just really find a way to rein in those primary deficits. It's just shocking, again, to me that we have primary deficits in an economy that's near full employment, no war, no recession.
That's right.
Now, we're headed into one. The job market data we got last week says things are softening, but I would say we're still, unemployment, I think, is 4.2, 4.3. Right. I mean, so it's still, I think, safe to say we're in a full employment economy. And yet we continue to run large primary deficits.
That's right. So exactly like you mentioned, the labor market is weakening. But again, so there would be probably interest rate cuts, 2 or 3 of them in the next couple of months. We know that because of the One Big Beautiful Bill, probably we have higher growth next year, even up to 2027. So I just don't know how the trajectory of the public debt and deficit would change at least in the near future.
Yeah. Whether we go into recession or not, it's a small part of this bigger story that we've been really drilling into and should be thinking about seriously. Now, Samim, we did not get to your private credit growth discussion. You have an actual paper you've written with Moody's, so we'll provide a link to it in our transcript, so I'll encourage listeners to go there.
Sure.
But with that, our time is up. Our guest today has been Samim Ghamami. Samim, thank you so much for coming back on the program.
Thank you, David. I enjoyed our discussions. Thank you.
Macro Musings is produced by the Mercatus Center at George Mason University. Dive deeper into our research at mercatus.org/monetary policy. You can subscribe to the show on Apple Podcasts, Spotify, or your favorite podcast app. If you like this podcast, please consider giving us a rating and leaving a review. This helps other thoughtful people like you find the show. Find me on Twitter at David Beckworth and follow the show at macro_musings.